It's a real pleasure for me to be here, and not just because I am otherwise in Boston, which is not quite as pleasing as LA this time of year, but it's wonderful to, I know so many scholars and others here at USC and from other schools locally that it's wonderful to be here to see you and to see so many new people, and I really look forward to getting a chance to talk with everybody today. Dean Knott did an excellent job of the pronunciation, which has long been not so long, but has been a bit of an issue. And for those wondering, not related. I know it didn't cross anybody's mind. My sister said, sometimes in our family we discuss, do you think enough time will ever pass when, people aren't going to think this? And my sister, ever the pessimist, said, that's what the Ponzi's thought, So, yeah. Anyway, on to happier topics, which is about tax policy, nonprofits, and philanthropy, and why charities are panicked in the wake of 2017 tax reform. My goal today is to talk about the central role that tax rules have had in shaping and creating our philanthropic and nonprofit sector. But basically, the takeaway, if you want to know what it is that we haven't been paying sufficient attention to how we shape those rules so that they produce the results that we want, the rules that are best for society. And we've been a little bit neglectful where we should have been paying more attention. As we'll see in the talk, there was the beginning of the connection between tax law and the charitable sector occurred about 100 years ago in 1916 with the creation of the estate tax, and in 1917 with the creation of the income tax. Both of those tax systems created at the time of their creation essentially a subsidy for those taxpayers who chose to give to charitable organizations. And so this was central in fueling our quite impressive charitable sector. 50 years after that, in 1969, for those tax lawyers in this crowd, was another extremely significant year. It's the time that Congress totally revamped our tax rules, created a separate category for private foundations, and we'll see put into place a transformation which served as the roots for what is going on today. So today we're going to be exploring all those changes. For those who have been figuring out the math, it was 100 years ago, it was 50 years ago, and so to get into the rhythm, we really should be taking up this issue again, which is how the tax rules should be addressing charitable giving to keep this economy being as central as it is. So let me see. Okay, so I want to talk a little bit about the role of nonprofits in the United States, because it's a little bit like fish swimming in water. It's a little bit hard for us to see our world that we live in. But it helps if you think about how other countries, particularly you might want to think about Western Europe, but many other countries throughout the world finance things like education, healthcare, food banks, housing, social services, scientific research, museums, symphonies, right? Throughout much of the world, these essential aspects of society are funded directly by the government, right? People pay taxes, and the government decides how to allocate resources over these activities. However, in the United States, we have a very different approach to it, right? A lot of these things are partially funded by the government, but they are also significantly funded by charitable donations, by philanthropy, and by individual charitable donations. So throughout all of these things, so I think I even have somewhere in here I have something that's going to shine, something bright, but I'm not sure I need it. But if for each of these areas, we have philanthropy and the nonprofit sector playing a significant role. However, when we have philanthropy, when we say it comes from the private sector and from donations from individuals primarily, but also from corporations, what we have to realize is that we also have a silent partner in each of those donations. And that is the federal, and in some cases, the state government, which provides tax benefits for these charitable gifts. And these tax benefits take several forms. First of all, you get a deduction for your charitable donations, right? There's a charitable deduction. For people who give appreciated property other than cash, they don't pay any capital gains, and they often get to take a deduction based on the full fair market value of the property. For people who are subject to the estate and gift tax, they get to avoid estate and gift taxes on the transfers to charities. And the charitable organizations themselves pay no income taxes. Okay, so those are the many tax benefits of charitable giving. And the effect of these tax benefits is that the government acts as a partner in the charitable giving, and savings can be quite significant. So if we imagine the gift of a $10 million private business interest, and it doesn't have to be a private business interest, but we're going to be returning to this example later on. But any $10 million gift, let's say it's a business that was created like so many businesses today with very little expenses, very little startup costs. Somebody starts something on their computer and all of a sudden it's worth a lot of money, right? They haven't invested a lot, so if they sell the business, they're going to have a big capital gains tax liability. But if they instead donate this property to charity, they get to avoid the 20% capital gains taxes. So that will save them $2 million. Even at our new lower income tax rates of 37%, which is the maximum tax rates put in place in the most recent tax bill, that will still save them $3.7 million. They'll get to offset their other income by $3.7 million. And there will also be a net savings because when they will save $1.6 million that would otherwise be subject to estate and gift taxes. Okay, which gives us potential savings. So if we're comparing somebody who's going to sell their business interest and pass on the remaining amount to their kids versus give the amount to charity, if they give it to charity, the government will kick in essentially 73% of the charitable gift. Right? There is a significant public investment. That's going to reduce the after-tax cost to the donor to only $2.7 million of this $10 million gift. By the way, I meant to mention up front, I know that some people in the audience are real experts in this field, but I suspect and hope that many of you have no expertise in taxes at all. Okay, and my goal is that the people that have no expertise in taxes understand exactly what I'm saying. So I would be most appreciative. When you have questions, please don't hesitate to give me a wave down, okay? Because if you don't understand it, I guarantee you other people don't understand it as well. Excellent, thank you, sir.
So the capital gains, you're assuming a basis of 0?
Yeah, that's what I'm assuming.
Okay. Yeah. So you have something that's fully depreciated, basically.
No, something that somebody started, but it didn't take much. Like they started it on their computer. Okay. So their only investment was their $1,000 or $10,000 computer, and now they've created a multi-million or billion-dollar business. Yes?
So is this a comparison to if someone were to, for example, give this to their heir, and if so, wouldn't you have a step up in basis?
No, if they were to sell it instead. Let's say that their business is about to go public, and they're going to sell the business, right? Then they'll have to pay capital gains. Right. They won't avoid the income taxes, and then they'll pay estate taxes on the remaining amount. Okay? Yeah, so that's what I'm comparing it to. Excellent, thank you. Any others? All right, you're already a star group. Okay, so lots of savings of, obviously not all charitable gifts get a 73% contribution by the government, but a well-planned one does. And well, we'll see later on about how certain entities existing today facilitate this type of maximum tax benefit giving. All right. So I want to talk now about some of the pros and cons of the US system of where we have this kind of indirect investment as opposed to the a system where you have direct expenditure by the government, right? So one is that it encourages a commitment of additional private resources, right? Right now, a lot of countries throughout the world are trying to build their philanthropic sectors because they have a lot of wealthy people, and they're trying to figure out how can we get those wealthy people to donate their resources for the public good, well, we can incentivize it by putting in tax benefits, right? So you get more money than you spend if you have a well-drafted tax system. So that's one of the great values of our system. More broadly, it disperses the power of government more broadly throughout society, right? Because it's not just a single body, the government, deciding how resources are going to be spent. It promotes a strong civil society. It promotes pluralism. You can have lots of different perspectives about how to spend money. And it provides an ingenious way of directing government resources. So Saul Levmore wrote an article called Taxes as Ballots. And he says that what's great about this system is that it's a way of using government resources to commit them in ways that people think of as being good. So it's lots of people give money to the Red Cross, then it's good for the government to be essentially directing its resources in the form of foregone tax revenue to the Red Cross. So that's another argument in favor of it. However, there are some concerns. One of them is that unlike direct expenditures by the government, this happens in a way that's largely hidden from view, right? So somebody makes a very large gift to some organization or charitable entity and they get their tax liability cut down. Nobody really knows about that. So no one can, it's very hard to track these tax expenditures and see what they are. The other is that the allocation of government resources is dictated by those who make the largest gifts. And the final one is that because of the structure of the current subsidy as a deduction rather than a credit, and for those of you who are not tax people, don't worry, we're going to come back to that. It means that a donation by people in the highest tax bracket, typically the wealthiest, gets a greater subsidy than those in the lower tax bracket. So I want to do an example of who gets the tax benefits to show you this. So look at a gift of $1,000, and now we're talking about a gift of cash, okay? If somebody is taxed, basically what a deduction does is it offsets the amount of income that you have. And so it reduces the amount of income that's subject to tax. So if you would otherwise be subject to tax at a 37% rate, then your income tax deduction is worth, of $1,000, is worth $370. If you are otherwise taxed at a rate of 15%, then the deduction is only worth to you $150, right? Whereas, and most importantly, if you do not itemize your deductions, if you take what's called the standard deduction, then you get no tax benefit at all for your charitable giving. Okay, you get no tax benefit. And that's because when you fill out your taxes each year, you can either take the standard deduction, which had been $6,000, or if you have more deductions than that, you can add up all your personal deductions, including your charitable deductions, and offset those. But if you take the standard deduction, you get no tax benefit for any charitable giving that you do. Currently, 70% of Americans, when I mean currently, I mean pre-2017 Act, 70% of Americans took the standard deduction and therefore got no tax benefits of their charitable giving. Okay, a significant portion. By the way, this thing here is called an upside-down subsidy. And for those who remember, there was something called the Obama haircut back in the days when Obama was president, and he said something like, we're going to limit the tax benefits to 28%. It was incredibly confusing, but what he was trying to do was to try to limit this kind of upside-down subsidy. It was really poorly chosen as an idea to put forth, you can imagine. Okay, so what I want to talk about first is about this idea that even prior to the tax law, 70% of Americans got no tax benefits of charitable giving. Now you might think, wow, that seems to me would have a significant effect on charitable giving, right? However, there's been some interesting work. This is Lily Faulhaber, but I think others have worked on this as well, which is the idea of HyperSalience. The idea is that the charitable deduction, although it is only available to 30% of taxpayers, those who actually itemize their deductions, so many people know about it. It is so well advertised that lots and lots of people think they're getting the benefit of the charitable deduction, even if they're not. right? Because they're not thinking, oh, wait, do I itemize or do I take a standard deduction, right? They don't have any idea, most people. And so, and of course, the charities, they build on this, right? They go, it's December, you got to give your gift now, right? Now's the time. Your time's running out to get your charitable deduction. And some huge proportion of charitable giving all occurs in like the last 2 weeks of the year, even from lots of people who actually will see no tax benefits of their charitable giving. Okay, so that's the idea of HyperSalience. Okay. Nonetheless, this has had its effect because there have been lots of studies that have shown that far fewer Americans are giving gifts to charities than have in the past. And a lot of, I don't have the exact numbers because there were lots of different studies, and frankly, it's an area where we need better research to be done because obviously tax returns won't have that. If we have 70% of the public, we're not going to have that information about who gave to charity. But in any event, there have been lots of studies. They've all said a lot of Americans are no longer giving to charity or giving a lot less, which is, I suggest, a problem for a society like ours, which is really dependent on, remember, if we're trying to promote pluralism and lots of involvement, all of this, this is a concerning trend. Okay, so why number, yes, sir?
Well, so the other thing that's going on is income inequality.
Yeah.
And, if you look at wages of the median, they've been sort of stuck for about 30 years while housing costs have gone up. And so what's left over is less.
Yeah, so middle-class Americans maybe are no longer as wealthy.
So, their budget doesn't
Yeah.
permit the
That's
kind
right.
of giving they were giving.
Yeah.
And that has nothing to do with the tax code.
And perhaps that has nothing to do with the tax code. Although I think that if it depends on what, one could have a generous enough subsidy, right? You could have a rule that says everybody can allocate $500 to whatever charity they want, and it wouldn't affect their taxes. You know what I mean? It wouldn't affect their, and then it would. So it's all how it, under our current tax code, they still have to chip in though. So it's, you're right. There are lots of factors that are causing this reduction of middle-class giving, I'd say. But nonetheless, charities have been running scared by a provision in the 2017 tax law, which doubled the standard deduction from $12,000 for a couple to $24,000 for a couple. And so the number of itemizers is expected to fall from 45 million down to 7 million. Only 5% of Americans are expected to itemize. Okay, so this is a real problem for charities because the concern is that this group of Americans, the group that from the 70% to the 95%, the group that's no longer going to itemize, are ones that tend to be more knowledgeable about their tax situation, more focused on whether they're getting a tax benefit or not, and therefore taking away the tax benefit could very well have quite a significant effect on charitable giving. And there's been lots of work about the effect of a reduction in tax benefits affecting charitable giving, including from Nick right here. And so there's lots of concern about this. Giving rise to headlines like this, charitable giving to take a hit from the tax law, it will devastate charitable giving, GOP tax law, a 1-2 punch to charities and American giving. By the way, the second punch was the estate tax. Estate taxes play a huge role in charitable giving. I want to just suggest one possible way of getting ourselves out of this situation. Oh, I should say that the charities have not just been sitting by the sidelines on this. They have their proposal. They pushed quite hard to try to get Congress to adopt what they called a non-itemizer deduction, which is that everyone would get the charitable deduction even if they itemized. The problem is something like that would be unbelievably expensive, and it would also sweep in that whole 70% of people that were giving anyway, even before, and so that went nowhere in Congress. I do think that there is room for reform, and I would suggest we look back to the SimpsonBowles, which was originally a deficit reduction proposal from 2010, which would be to replace the deduction with a credit for donations. So for those of you who are like, oh my God, she's saying credit, A credit, as opposed to a deduction, is basically something that you take off of your tax liability at the end. So let's say you apply the deductions, you do everything. Now you owe $10,000 in taxes. A credit, if you have a credit for $1,000, it reduces your tax liability from $10,000 to $9,000. So it comes off the top. So it applies to everybody the same, regardless of what your rate you're being taxed at. So it would equalize it. It would bring in for everyone. I think that in order to, since what we want to do is we want to encourage additional charitable giving, I think it's really important that we have a floor. And so I like that they have a 2% of adjusted gross income. So this was a proposal to say, a 12% non-refundable tax credit to all taxpayers who give above 2% of their adjusted gross income. That would be one way of addressing this problem that I think would bring in more people into the tax world. There's obviously lots of other ways as well, but this is something that's playing a big role in charitable giving. Okay, I want to turn now to talk about another critical question and issue in this area, which is what counts as a donation to charity? And I'm going to call this as the problem of donor control or donor-controlled entities, because this is how the problem has been seen in the history of our tax law. So the idea is that when Congress created tax benefits for charitable giving, it did so with the idea that we want to encourage the growth of nonprofit organizations like universities and hospitals and food banks, and the Red Cross, right? These things that we traditionally think of as charitable organizations. However, there were also other types of charitable organizations that were being formed at the time, and that as tax rates went up, became more and more popular. And these were charitable organizations formed by individuals and families that did not themselves engage directly in charitable work, but provided funds to other organizations that do, right? Like private foundations. So a private foundation is also a charitable entity. It is funds devoted to charitable resources, but instead of being committed to a particular instead of being engaged in promoting a particular mission, it is more like a bank account that gets allocated. And if we go ahead to 1969 or back to 1969, right? Age of Aquarius, Sugar Sugar by, is anybody old enough to know who did these? Thank you. The Archies was the most popular song. Neil Armstrong landed on the moon. And for us tax lawyers, an equally exciting event, Congress enacted the Tax Reform Act of 1969 that significantly overhauled the world of philanthropy. And this had come as Congress had been concerned about private foundations and was there sufficient public benefit coming from them? So what types of oversight or things should we provide? There were lots of rules that were put in place along the way, but 1969 was really the big year and kind of the birth of actually the private foundation, even as terminology in the tax world. Okay, so basically what Congress did in 1969 was it drew a distinction between two types of public charities. And they said that public charities were going to be treated just the same as they always were. They get all the same tax benefits and they have all the same lack of reporting requirements. But private foundations, this thing that they were going to call private foundations, were going to be subject to a new regime. And this new regime had a number of features. One was that they had less beneficial tax rules for donations. And the most important one is that remember back to the slide about the business interest where the person donated the $10 million business interest, but they had created it on their computer, so they had very little basis, what we call it in it. Okay. They said that if you were giving something other than publicly traded stock, if you're giving something like a business interest or other property, the value of your deduction is limited to your cost. Right? So in our $10 million donation before, if you give it to a private foundation, your deduction is limited to $10,000 or whatever you paid for your computer. Okay, so that was a pretty significant cutback on tax benefit of charitable giving to private foundations. They also provided a lot more disclosure. They required private foundations to fill out this Form 990, which gave lots of information about how they were spending the money, how they were doing grants and things like that. They also subjected private foundations to an excise tax, but I didn't want to push people over the edge by including it here, but I will say it here. And then, most notably, they included something called a minimum payout rule that required private foundations to spend 5% of their assets each year. And the concern was that they didn't want money that had received the tax benefits of charitable giving to just stay in an account subject to donor control and not be put to public benefit. They were concerned about the time delay between the tax benefit of the charitable giving and the public benefit of the money being put to use, right? So they said, we think this is a good balance, 5%. They had considered other rules. One of them was to put a 25-year life on private foundations, which would have really changed the world that we live in, right? But they said, no, let's do this 5% because there are a lot of organizations had been set up in perpetuity, and they wanted to maintain the possibility of perpetual organizations. For more on that, see The Rising Power of the American Dead. Thank you for the... Okay, so what does it take to be a public charity as opposed to a private foundation? Because now, remember, you want to be a public charity, right? So they said certain organizations, depending on the type of organization, is automatically a public charity. If you're a religious organization, a school, a hospital, or you're the government, those are automatically public charities. But you can also be a public charity if you are publicly supported. Basically, if a lot of people support your mission, right, then we're going to take it as a sign that you're an organization that is worthy of this preferred treatment of being a public charity. And the rule was that 1/3 of the organization's support is from individuals who give less than 2% of the organization's total support. What you need to understand here is they were saying we're not talking about a charitable entity that is funded by an individual or a family, where all the money comes from just a couple of people. Okay? All right. This change, right, this of the treatment of private foundations and the sort of less beneficial treatment really fueled the rise of something called donor-advised funds, DAFs, as we call them in the field. Okay, so donor-advised funds, I suspect if this group is like every other group I've ever spoken to, we're going to have some people who are like, oh my God, DAFs. Of course, they're all over the news. And other people who are like, what the heck is a DAF? I have never heard of this before. And this is going to be very exciting because you're going to see something really surprising that's coming down the pike. Spoiler alert. Okay, so what is a DAF? Okay, basically what it is, so technically speaking, is it's a public charity, right? So something that receives lots of support, that agrees to hold funds in a separate account and await advice from the donor about how to spend it. Okay, so sometimes our sponsoring organization is a traditional charity. Cornell University has lots of DAFs. USC might have DAFs. So sometimes it's just basically a regular public charity that we know of. Community foundations were the original source of DAFs. I like that song. So community foundations, this was Boston Foundation, California Foundation, lots of foundations. Cleveland Foundation, they house DAFs. Right? Remember, DAFs is basically, it's a donor-advised fund. It's a separate account in the donor's name. And more recently, banks, Fidelity, Schwab, Vanguard, Goldman Sachs. So beginning in 1991, banks realized, wait a second, we can create our own public charity that can hold people's donations. And they can give us advice. It can be a financial vehicle. And DAFs became unbelievably popular. So first of all, the advantage for DAFs for donors is they get the maximum tax benefits. Remember I said that you get more tax benefits giving to a public charity than you do to give to a private foundation, particularly for what the DAFs called complex assets, so appreciated property other than publicly traded stock. You have no payout rule. You have no disclosure requirements. But yet you have ongoing control. The donor is given the ability to decide how the DAF funds can be spent. Yes?
So this is actually binding, right? So it is, we have to do what they tell you. It's not just...
No, it is not binding.
Okay.
So the interesting things about DAFs is that actually, in order for them to work from a tax point of view, the donor has to give up all control. So if somebody gives $10 million to Fidelity Charitable, technically that's the exact same as if they gave $10 million to the Red Cross in an unrestricted gift, because otherwise you don't get the tax benefits. And you sign something that say, I'm giving up all control to Fidelity Charitable. But of course, they're not really giving up all control to Fidelity Charitable, because they wouldn't give it to Fidelity Charitable if Fidelity Charitable is going to decide how to spend it. So it all operates kind of outside the law, where basically there's an understanding that, of course, they're going to do what the donor wants. And they do what the donor wants, because they don't make money by stealing the money. They make money by getting fees on managing the money. Okay? So just a little bit. So here was something from 2013. Look at the growth of DAFs from 2008. 5 billion. These are contributions. 6 billion, 7, 8, 13, 14. Okay, this is up to 2013. Any idea what has happened since 2013 to our mountain range? Right? Definitely this roof will not, this ceiling will not keep it in. So 2014, 19 billion. 2016, 21 billion. 2017, 23 billion. And I suspect that 2017, these are, 2017, we don't have the numbers in yet, but I suspect we are going to see something quite astronomical because of the tax law changes that occurred. So, pop quiz. What charity, so every year the Chronicle of Philanthropy publishes what charities get the most donations. What charity received the most donations last year? In Boston, we think the Red Cross. That's a good guess. In Boston, we'd say Harvard University. Here, we might say USC. You've received very generous donations, right? Fidelity Charitable, #1 recipient. But that's not all. Because look at the top 11 last year. Fidelity, Schwab, National Christian Foundation, Silicon Valley, Vanguard Charitable. Each of these are donor advised funds. Okay, this is something that is, these are barely, they're barely on the scene, and they are dominating. Even before the tax bill, this is gifts to Fidelity Charitable soared to $6.85 billion. They had a huge increase in every year. They're just having greater and greater increases of donations. Fidelity is just one of them. But basically, the 2017 bill accelerates the value of DAFs. And these are really the value of donor advised funds. The first one is that imagine our business owner who has that business, and the business is going to go public, right? If they sell the business, they are going to have a big tax liability. If they might be charitably inclined, right? But if they just give it to the Red Cross or even USC, that's it, they've given it. And now they can't give from it again. What a donor advised fund enables somebody to do is to take their big gift, particularly one that's going to potentially cause tax problems to them if they don't give it right now, and get all the tax benefits of charitable giving up front. It also allows them to, something that's going to be very valuable going forward, to bunch their gifts. Remember we said that the tax bill, you don't get, if you don't itemize your deductions, you don't get any tax benefits. Basically, all of the articles in the paper about tax planning for the future were open up a donor advised fund and then accumulate your gifts so you give more than the standard deduction, and you'll get your tax benefits of charitable giving, and then from that account, you'll trickle out your gifts. So that's another advantage. Basically, the idea is that you get all the tax benefits of charitable giving, but you get to give it over time. But let's say you want to give away $10,000 a year, right? If you give under current law, if you give $10,000 away every year, you might get no tax benefits of your charitable giving. But if you give away $50,000 into a donor advised fund, now you get the tax benefits of your charitable giving, and from that account, you can give $10,000 a year.
But you can't reclaim that.
You can't take it back for yourself, no. It's committed to charity. Yeah. So it basically, what it does is it lets people time their charitable deductions for the way that provides the maximum tax benefits, either because they're in their highest tax bracket, or because they're going to have an event where their property is going to be sold, or for some reason they want to capture maximum tax benefits, and donor advised funds enable them to do that. Because they've set the money aside into a vehicle, and from that they can make gifts. Okay? Does that make sense? Yes?
Yeah.
Are the institutions and the DAFs siloed, or are they connected? Like, can Fidelity as a company use their DAF for selling a property they may have and to give anything to their DAF, or do they stay separate in terms of their relationship?
I'm confused with the they.
So the Fidelity, the actual corporation,
Yeah.
are they connected with?
Yeah, so the actual corporation, they say, no, we're totally distinct. We have nothing to do with each other at all. But the thing that Fidelity Charitable does is they market to all of the Fidelity customers, and they make it very easy for the money to be transferred back and forth. And then they take all of the invested funds and they say, look at all these Fidelity accounts. You can invest your money that you've set aside for charitable spending in. And there's huge amounts of money in donor advised funds. So right now, the most recent estimate comes from 2 years ago, and there has been an explosive growth since the last 2 years. But 2 years ago, there was $85 billion in donor advised funds. So there is a lot of money in donor advised funds. And it makes sense because they provide huge amounts of tax benefits. Basically what you get are the maximum tax benefits of charitable giving plus ongoing control over your money. And who doesn't want control? I mean, it's a natural human thing, right? If you could give it away and have no control, or give it away and have control, people like control. And frankly, part of the reason of the growth is just very natural human tendencies for people to want to have control. Yes?
Could you offer some editorial comments on the appropriateness of this as a policy matter? We have a lot of experience in other areas, insurance, wrap products, the donor advised fund is a private foundation by another name in substance. So could you offer some editorial?
Sure. And I got a slide right here. Here are some of my concerns raised by DAFs. Okay. So the number one concern is that they have no required payout time. And the organizations that are holding on to these funds, right, think about Fidelity as just sort of a classic. What is their interest? What is the financial interest of Fidelity other than, thank you, to hold on to the money? Because they get fees when the money is under management. And there's some who have said, yes, but community foundations, those are the good guys. You should be drawing a distinction between community foundations and and the financial, the commercial ones. They're always like, don't call us commercial, call us national, says Fidelity, Schwab, Vanguard, Goldman Sachs. But in any event, community foundations say we're different. And it's true that community foundations have a mission to serve their communities, but they also have a financial interest in keeping funds under management because they get fees. So Silicon Valley has many billions of dollars in donor advised funds, and they get significant fees from keeping the money under management. And so that, I think, from what I've heard from people who work at these community foundations, that they are encouraged to have people keep their funds as well as spend their funds. Yes?
Is there a limit to the fees?
No, there's no limit at all, because the only limit is the limit of the market, though. Fidelity has served as a very powerful because their fees are so low, because they're a financial institution. Really what a lot of the service that they're providing is conversion of assets. They're providing a clearinghouse of assets. And I'll tell you another example where somebody would want to do it. And one of my other areas of main concern is, let's say, for example, you have a condo in Florida that has not done so well weather-wise recently, right? And you have a hard time. You want to sell that condo, and you say, oh, this condo's worth $300,000, right? If you go to sell it, you're going to have all that time before you sell it, right? And then you have to pay real estate fee, brokerage fees and things like that to sell it, and you'll eventually get whatever money you get. But if instead you take that condo and you give it to Fidelity Charitable, I'll just say, because they're the biggest one, you get your current fair market value of $300,000. Even though the money that will ultimately go to charity is going to come after the monthly condo fees are paid, the real estate brokerage fees are paid, all these fees get paid along the way, and those are all fees of the charity, as if it's just regular charitable expenditures. And so I think there's a real problem with valuation that we need to look into, because it might end up being that we only have $200,000 or $150,000 going to charity. And remember, that $300,000 gift has cost the rest of us a lot of money in foregone revenue. Yes?
Well, I guess maybe I'm not understanding. So suppose I'm Fidelity, and I put $10 million in the foundation.
No, these are, the $10 million is coming from everybody in this room who's putting our money to Fidelity Charitable.
Okay, but didn't Fidelity start with its own money going into it?
None of its own money.
Oh, it's none of its own money?
No.
Oh, okay, all
Yeah.
right, now it's,
Yeah.
okay, so the scheme I had in mind can't be done.
Okay. Yes.
Two questions. I can see the obvious benefits for a donor to consider a donor advised fund, but one is, has there been any analysis done on the fees that are charged by these third parties like Fidelity to manage the investments and also the decisions regarding where the money goes and all the administrative support that's required versus private family foundations who do it themselves?
Yeah.
That's one question. And the other is there any way of qualifying the value that these third parties provide by way of the quality of the decisions that are made with regard to where the charitable funds go?
Yeah.
I mean, we're a private family foundation, they have a mission and objective, and there's something specific they want to accomplish. Are they just pass-throughs that happen to have a very sophisticated back office and so on? Or do they add value to the process of how does my dollar make the most difference?
Right. So what they would say is, and this is sort of the big dispute between the community foundations, the other big players in the field, and the donor advised fund sponsors, right? So the community foundations say, hey, we help people give intelligently in your community, and or also, like you say, in the private foundation when there's a strong mission-driven organization of employees. And what Fidelity says is, well, we don't need that. What we do is we let every individual decide what their charitable giving is going to be, and their strength is their back office. Basically, they have low costs for converting assets to charitable assets.
So it's more just a facilitator,
Yes, really
not adding value to the philanthropic process.
Right. They'd say they're adding value to the philanthropic process by facilitating charitable giving. They make it so easy for people to give and to get maximum tax benefits. The problem is when you're looking at it from a public policy point of view, maximum tax benefits for donors are maximum costs for the government and for the other taxpayers. And so it's, it all depends on from which perspective one's looking. So the other concern is that once funds are in a DAF, donors can lose that urgency about making donations. Remember, you've gotten your tax benefits. Now you have funds in your DAF set aside. And we've worked with Jim Andrioni, who's a behavioral economist that some of you might know about charitable giving. And he's talked about how when people switch their way of thinking about their funds, so now you've made a gift, now all of a sudden you're getting statements from Fidelity, and you're watching your account grow, and you get a sense of identity, and you love watching it grow, because look at how much money you've committed to good. But then if you actually spend it for good, oh my God, it's nothing. It's gone way down because, again, we're humans and this is how we respond to things. And so this is my other concern about DAFs, is they shift our way of thinking about charitable giving from something that's giving it away to something that's an asset that we control. Even if we don't legally control it, it's there in our name. And so we have a different sense about it. Of course, the sponsors have an incentive to encourage saving rather than giving. Yep. Oh, wait, we've got a couple of questions. Yes.
So, more a statement than a question. Seems to me you're dancing around two other aspects of the DAFs that are very troubling. One is the classic case of the private business. You arrange a sale, you have almost a deal, and then you give to the DAF the day before,
Right.
so to wash out all the gain.
Has to be 2 days before.
Sorry. And the second is the point, it's a following on the point we're just making, that with a fidelity, as opposed to a community, which is, they have no interest in what charities are chosen. They
Right.
have no mission of their own, not even a pretense of a mission.
Right.
And that just makes the sham argument all the more powerful, that this is, in fact, nothing but a sham.
Well, some have argued that. There's a recent article in the Stanford Social Innovation Review which says that basically that the commercial funds they shouldn't even be recognized as charities because they're just doing this conversion of assets. And I think that there's a lot of, so I think that that's an argument that is out there. I do think that, unfortunately, that's actually what these other, like for example, I mentioned that Cornell has a DAF. You don't have to give any of that money to Cornell. If you give them sufficient money, none of it has to go to Cornell because everybody's becoming a money manager now, is really what's happening. Basically, it's a charity getting into the business of money management. Yes?
If somebody gives to a DAF and then they pass away maybe unexpectedly,
Yeah.
does Fidelity basically get to keep that money in perpetuity?
You know what they encourage you to create a legacy fund because their interest is, again, in the money being, so they said pass it on to your children or grandchildren or great-grandchildren, right? Because it's all in their interest to have more, to have the money built up, to build the sense of ownership. Another concerning aspect of this whole system is that DAFs, because they're a public charity, can be used by private foundations to meet their 5% payout rule. And so The Economist magazine did some interesting work. Again, it's very hard to figure out how many are doing this, but one thing The Economist magazine found was that the ones that are doing it significantly. They're giving like 95% of their 5% to a donor advised fund where it is no longer subject to a payout rule. So that's kind of it seems to be a real end run around the system. And finally, it's difficult to track what is going on with these DAF dollars. So if we had a DAF representative here, we'd have somebody say, hey, but DAFs distribute 16% and private foundations only do 5%. But we'd actually have very little idea where the money is going. Pop quiz number 2. What charity received the most DAF distributions from Fidelity Charitable, Schwab Charitable, and Vanguard Charitable last year? What charity think, what's that? The Red Cross? I like it, you're sticking with the Red Cross. All right, let's see. Fidelity Charitable. Because the distributions are going, so for example, somebody has money at Schwab and they think, oh, you know what, I don't like Schwab anymore, I like Vanguard. I'm going to give my money to Fidelity. That counts as a distribution. And we have no way of tracking so we have no idea what's going on because remember, this is all happening outside of the law and outside of regulations. Okay, so just some quick points. 2 ways Congress could close donor control loopholes. One is impose some term year payout on DAF funds, 10 years, 20 years, something, so that we know the money would be committed to charity. And also disallow private foundations using DAFs to meet the 5% payout requirement. These seem to me to be fairly reasonable rules in this area. But one problem, what can we expect in the future in terms of regulation in the area? And one of the challenges is that if you think about the interest groups in keeping things like donor advised funds, right? All the financial institutions and the community foundations and financial planners. Did I mention that people's individual financial planner gets a fee for money in the DAF? Your own private financial planner, so they're luring more money into DAFs, right? Don't give it to the Boy Scouts, give it to Fidelity, because then I'll get a management fee still, okay? So many interests. And one of the things we tried to do last year in my work as head of the Forum on Philanthropy and the Public Good was we brought together a group of big nonprofit leaders to say, hey guys, you're really being hurt by the tax rules because money's not getting to nonprofits. And basically, do you know what their response was? We don't, exactly. You just did the perfect, we're not going to touch that with a 10-foot pole because not surprisingly, they did not feel it was in their best interest to go out and alienate their donors by saying, hey, we should have new tax rules on our wealthy donors, right? That was not seen as the number one activity or that organizations like this should be engaged in. And so we have a real problem now because the nonprofits I believe, are being harmed and are going to be even more harmed going forward. And the question is, who's going to be able to stand up for the interests of the nonprofit? So that's sort of the challenge going forward. And that's it. Thank you very much. Yeah, I'd love some questions. And yes, back there.
I was just wondering, $22 billion has gone to Fidelity Charitable. Does that mean, presumably most of that would have gone to nonprofits before, so are we,
It was 68.5 billion.
so that would have gone to a nonprofit previously?
Well, you know what? It's very hard to know where money would go or what. We have very bad data is one of the problems. And so it's quite difficult to know. I mean, one thing we do know is that charitable giving has remained relatively constant as a percentage of disposable net income, roughly 2% of disposable net income, but that doesn't really tell us very much, I'm afraid. So it's hard to know what would happen without them. Yes?
Years ago when the Fidelity and other commercial DAFs got started, some lawyers here in town made an argument that there was too much private benefit because of the management fees.
Right.
Any chance of that coming along again?
No, I don't, and they don't even report them. They do get $56 million, but they basically they have separate. I don't think that's going to be because the problem is it's a little bit like retirement money, where you don't really see the fees because they're hidden in the investment of the funds, right? When Fidelity gets fees, you just see it as a slightly reduced return. But there's been some very interesting work done that has been about how DAF dollars, that showed that DAF dollars produced a much reduced return than what the market would be reduced. So that's, I think, going to be a powerful opportunity for more research in that area. Others? No, yeah.
The other thing that it has been happening and we can expect to see more of is...
This is, by the way, is Ellen April, for those who don't, one of the nation's biggest tax experts on charitable giving generally. So,
is that we're going to see money going to C4s. Because they will do it for the educational purposes of the C4, allowing more dark money for campaigns.
yes, you mean if we don't have tax benefits for charitable giving. And that's an interesting thing, how the failure to provide tax benefits does mean that it makes different opportunities for people to give. And one of the reasons I think that people have, that there's been reduced charitable giving, has been the rise of things like GoFundMe and other things where people are giving without being mindful, without worrying about the charitable benefits. So it does play a big role in how people give. And I would suggest also, some of you might have seen about how Zuckerberg Chan, when they made their big pledge of charitable giving, they didn't need to worry. They said, we're going to use a non-taxable, we're not going to make it a charitable gift. And that's because we don't otherwise subject their capital gains to tax. So our tax system plays a big role in what people do. So anyway, thank you so much, everyone. I really enjoyed talking with all of you.